All right, almost finished with this process of going public. Once we go public, what do we typically see on the first day of trading? Well, IPOs get a lot of attention, and one of the reasons they get a lot of attention is they don't happen a lot. Companies often try to draw attention to it, right? They try to use it as like a marketing tool for how big and cool, and like I said, they're big boys and girls now. And so, yeah, IPOs get a lot of attention for that reason. They also get a lot of attention because a lot of times they often have very, very high first day returns. Now, why? Well, first of all, an investment banker is going to probably try to make sure it's oversubscribed, right? So that there's a lot of demand built up for the stock. And so, first of all, it's going to be oversubscribed. There's not going to be enough, supply to meet the demand. It's probably going to be underpriced. All right. As much as the investment bank can get away with it, they will underprice the stock. Right. So they aren't going to do it to such an extreme to piss off the firm, the customer. But they are going to underprice it as much as possible to make sure it actually sells. Right? They don't want to be stuck with it, and they want to get all this attention. And so that combination of the abundance of demand, the lack of supply, and then the underpricing all comes together in this lovely little fit to generate these super high first day returns. So this is just some stats from your book. During the period 1980 to 2016, higher than expected demand in the roadshows caused about 26% of IPOs to have a final offer price that exceeded the top of that price range. On average, these stocks subsequently went up on the first day about 50% in one day. For the 28% of IPOs with an offer price below the bottom of the initial range, the average first day return was about 3%. But it's still not bad for one day. However, a large percentage of those actually had negative returns. About 46% of IPOs had an offering price within the initial range. And for those guys, the first day return was about 11%. Now, you don't always have amazing first day returns. Sometimes these stocks do bomb out. Facebook actually didn't do great when it had its IPO. They even say in the book how the underwriters had to go in and create some artificial demand to keep the price up by purchasing the shares because the price was falling. So not all IPOs are going to have these crazy returns, but we do see it. Now, here's the life lesson for students. Don't try it. Okay. Here's the reason why. Limited supply, right? Unless you're the very best customer of that investment banker, you're not getting the IPO. They're going to give and not give, but they're going to allocate shares to their very, very best customers, I should say. Why? Because those very best customers are going to generate future commissions for me. A lot more than just some little individual retail investor who maybe makes 2 trades a year. Right? And so it's a way for me to basically give a favor to my very, very best customers. That way they keep being my very, very best customers. And so if you buy a stock on the first day, an IPO, you're probably the sucker. You're probably the person that's causing their very, very best customers to have super high returns. If you're one of the subsequent purchasers of it on the first day, you're not getting the nice underpriced stock, right? You're paying the inflated prices that are getting to be inflated because of all the hype and the demand and the news and the attention, right? So I always warn my students about that. Don't be that person, kind of thing. Don't be the sucker. Now, long term, how do IPOs perform? Not any better than other shares of stock. So it says, although IPOs on average provide large first day returns, their long-term returns over the following 3 years are below average. The offering price appears to be too low, but the first day run up is generally too high. So, and of course it just depends on the study you look at. Of course there's 10,000 studies on IPO performance and everything, and do they ultimately underperform or overperform? It depends on the time period, depends on the metrics you look at. This is what academics do in finance. Now, the last thing here about, and this is kind of related to that first day of trading kind of thing, this whole idea of going public is expensive, right? There are both direct costs that are associated with it, things like fees for lawyers, auditing, printing, engraving stock certificates, registration, filing. Average direct costs are about 7% of gross proceeds for smaller IPOs, so less than 50 million. And then as you move up in size, of course, economies of scale kick in, and the costs as a percent of gross proceeds goes down. Drops to about 1% to 2.5% for the very, very large IPOs. But still, that's like just straight up money that you're not getting, that's going to the investment bank. And there's also indirect cost. And the indirect cost is kind of related to that first day phenomena. That the indirect cost is what's called money left on the table. Meaning that we know that the investment bank is going to underprice on the first day and sell the stock for less than what it ultimately is probably going to settle at, once it kind of finds a nice equilibrium price. That's money that the firm could have had. Instead, there's some, rich dude that just got richer because he was able to get in on the IPO. The firm would like to have that money. So the difference, it says, between those two, it says the increase in the stock price the first day of trading over the issue price during an IPO, aka compare like the initial offer price, right? Because that's what the firm is going to get their net proceeds from. Compare that to what the market price ultimately ends up kind of settling in at. That is money that was left on the table that the firm could have had to go do more projects and grow bigger and faster and stronger that they don't get. So yeah, there's both direct costs, actually money that we just have to pay out to the investment bank basically. And there's indirect costs, that money that gets left on the table. And it relates back to how we price the stock on that very, very first day. So one more topic to cover with IPOs and this idea of going public is the importance of secondary markets, and why, even though IPOs happen in the primary market, as do SEOs, secondary markets are also important. So that's the next video.